Hey everyone! Welcome back to our channel, your home for smart money moves, investing, and building long-term wealth. Today, we're diving into one of the simplest yet most powerful investment tools ever created, the index fund. If you've ever wondered, what exactly is an index fund? How is it different from a mutual fund or ETF? And why does Warren Buffett recommend them for most investors? Stick around because by the end of this video, you'll know exactly how index funds work, why they've made millions of people rich, and how you can get started today, even with a small amount of money. Let's jump in. Section 1. What is an index fund? Let's start with the basics. An index fund is a type of mutual fund or ETF that tracks a specific market index, like the S&P 500, NASDAQ 100, or Nifty 50. Think of an index fund as a mirror. Whatever companies are in that index, the fund buys them in the same proportion. So, if the S&P 500 goes up 10%, your S&P 500 index fund also goes up about 10%, minus small fees. In simple terms, you're not trying to beat the market. You're matching the market automatically. And that's actually a winning strategy over time. Section 2. How index funds work. Here's how it all comes together. 1. You invest money in an index fund. 2. The fund manager buys all the stocks in the chosen index, like the 500 companies in the S&P 500. 3. The fund's value moves in sync with that index. 4. You earn returns as the overall market grows, through both price appreciation and dividends. Since index funds don't require active stock picking, they're passively managed, which keeps costs super low. That's why famous investors, like Warren Buffett, say that index funds are the best investment for the average person. Section 3. Why index funds are so popular. Let's talk about why index funds have exploded in popularity over the last few decades. 1. Low cost. No high-paid fund managers making trades daily, so expense ratios are tiny, as low as 0.03%. 2. Diversification. One index fund can give you exposure to hundreds of companies. If one stock crashes, others balance it out. 3. Simplicity. You don't need to study charts or pick stocks. You're buying the whole market. 4. Proven performance. Over time, the market has historically risen. For example, the S&P 500 has returned around 10% annually on average over the long term. 5. Compounding power. Reinvesting dividends and staying invested for decades turns small investments into large sums. Basically, index funds let you profit from capitalism itself. As businesses grow, your wealth grows. Section 4. Types of index funds. There are many types of index funds, depending on what market or goal you want to target. Let's look at the main categories. 1. Broad market index funds track entire markets. Example: Vanguard Total Stock Market Index Fund, VTSAX, or Nifty 500 Index Fund. 2. Large cap index funds focus on big, established companies. Example: S&P 500 Index Fund FXAIX, VOO. 3. Mid-cap and small-cap index funds target smaller companies with higher growth potential, but more risk. 4. International index funds provide exposure to global or emerging markets. 5. Bond index funds track government or corporate bonds for stability and income. 6. Thematic or sector index funds focus on tech, energy, green funds, etc. Good for specific exposure, not beginners. Section 5. Index funds versus mutual funds versus ETFs. Okay, now let's clarify a common confusion. What's the difference between index funds, mutual funds, and ETFs? Feature index fund, mutual fund, ETF. Goal track a market index, beat the market, usually track an index, like index fund. Management passive, active passive. Trading end of day. NAV end of day and AV throughout the day. Cost low, higher, lowest. Tax efficiency high, moderate, very high. So basically, All ETFs can be index-based. Some mutual funds are also index-based. But the core idea of an index fund is to mirror the market instead of trying to outsmart it. Section 6. How to invest in index funds. Alright, let's get practical. Here's how to start investing in index funds today. 1. Choose your goal: long-term wealth, retirement, education, etc. 2. Pick your platform. Use brokers or apps like Vanguard, Fidelity, Schwab, Xarata, or Grow. 3. Select your index fund. US example: Vanguard S&P 500 VU, Fidelity Zero Total Market Index FZROX. India example: Nippon India Nifty 50 Index Fund, HDFC Index Sensex Fund. 4. Decide your investment method: SIP Systematic Investment Plan. Invest a fixed amount monthly. Lump sum. Invest a large amount at once. 5. Stay consistent. Don't panic during market dips. That's part of the process. Section 7. Pros and cons of index funds. Like any investment, index funds have strengths and weaknesses. Pros: low fees gives higher long-term returns. Diversified gives reduced risk. Simple to understand gives perfect for beginners. Great for long-term wealth building. Cons: no chance of outperforming the market. Returns can fall during market downturns. Less flexibility, you follow the index exactly. But for most investors, especially beginners, these trade-offs are more than worth it. Section 8. Myths about index funds. Let's quickly clear up some common misconceptions. Myth 1. Index funds are boring. Maybe, but boring often wins in the long run. Myth 2. You can't lose money. False: they follow the market, so they do fall during crashes. Myth 3. I'll get rich quickly. Nope. Index funds build wealth slowly and steadily. Myth 4. Only old people invest in index funds. Actually, most young investors use them for long-term compounding. Section 9. Real examples and returns. Let's look at some real numbers. If you had invested $10,000 in an S&P 500 index fund in 1990, it would be worth over $180,000 today, without doing anything fancy. That's the magic of long-term compounding. And if you invest consistently, say, to $100 every month, you could reach $1 million in about 35 years, assuming an 8% annual return. That's why index funds are called the Lazy Millionaire's Plan. Section 10. Final thoughts and call to action. Here's the truth. Most people don't need to be stock-picking experts or market timers to build wealth. All you really need is discipline, consistency, and time. And index funds are the perfect vehicle for that. They let you own a slice of the entire market, grow with the economy, and sleep peacefully knowing your money's working hard for you. If you found this video helpful, hit like, subscribe, and share it with a friend who wants to start investing. And tell me in the comments, which index fund are you planning to invest in this year? Until next time, Govy Bro from Govy Education. Stay invested, stay patient, and let compounding do the heavy lifting.